What if I told you mortgage rates could finally fall below 6%? But not until 2026. Fannie Mae just released a brand new forecast, and it's got big implications for buyers, sellers, and anyone watching the housing market. Hey everyone, I'm Christian Medina, your local real estate expert here in Chino and in the Inland Empire. If you're thinking about buying, selling, or just keeping an eye on the market, this video is for you. Make sure to stick around until the end because I'll share what I think this means for your timing over the next 12 to 24 months. Mortgage rates are expected to finish this year around 6.4%. By the end of 2026, rates could drop to 5.9%, the first time under 6% since 2022. This is actually a downward revision from just last month, when they expected 6% in 2025 and 6.5% this year. As of last week, 30-year fixed rates averaged 6.26%, according to Freddie Mac, which is an 11-month low. But they might tick back up towards 6.4% by the end of this year, depending on bond markets and inflation data. Rates move with the 10-year Treasury yield, and the Fed's next move in October will be huge. More than 80% of homeowners right now already have a mortgage under 6%. That means even if the rates do dip, many sellers won't rush to list because they're locked into those ultra low pandemic era rates. Now for buyers, crossing below 6% could feel like a psychological win. But affordability isn't just about rates. It's also about income and home prices. To get back to 2016 through 2019 affordability levels, we need either home prices to drop nearly 40% or household incomes to rise 60% or rates to fall all the way down to 2.35%. None of these are likely to happen in the near future. Fannie Mae revised home sales down slightly. 2025 is projected at 4.72 million sales, 2026 at 5.16 million. Existing home sales are still at the lowest pace since 1995. But there's a bright spot. New home sales surprised everyone in August, surging to their highest levels since 2022. Now, what does this all mean for you? If you're buying, waiting for 2026 may not actually save you money if home prices and demand rise again. You may want to take advantage of current incentives, rate buy downs, or negotiate while sellers are still flexible. And I'll tell you this, since November of 2024 up until now, it's been really great for at least my buyers. Every single buyer that I have worked with has gotten anywhere between $5,000 to $35,000 in incentives. The one I just closed last week, first time home buyers, they got $15,000 to cover all their closing costs and even get a rate buy down. So they got a lower rate than they would have without that cash. When repairs came abroad, they actually got an extra $1,200 credit for that as well. So right now, as we're talking here in September, things are really great for buyers. It's a great time to look at those homes, and there's a lot of sellers out there right now that are more flexible and are looking, to give incentives in order for them to move on. Now for homeowners, a dip below 6% could bring more buyers back into the market, but don't wait blindly. Pricing and marketing are still what will move your home. And for investors, keep an eye on the bond markets and Fed communications. Small changes in inflation expectations can swing rates quickly. So the question is, will rates falling below 6% fix the housing market? Not by itself, but it could shift buyer psychology and spark new demand. The key is to watch not just rates, but affordability as a whole. If you found this helpful, please make sure to hit that like button and subscribe so you don't miss any of my weekly videos. And if you're planning to move soon, call or text me directly at 909-374-4260 or visit christianmedinarealtor.com. I'd love to help you plan the right move at the right time. Finally, YouTube thinks this next video is the best one for you. Check it out right here.